Hello, and welcome to the market update for Tuesday, November the 22nd. As always, if you have any questions during the week or any questions I don't get to here in the live class today, make sure you send those to Jerry, that's Jerry, at TradersPro.com. I'll be happy to answer those for you. Just a couple quick announcements. Obviously, this is a holiday week. Thanksgiving is on Thursday. The market's going to be closed on Thursday. Now, most of us here in the U.S. are used to that and would expect that, and so it's not that big of a deal. But I do have international students that are part of this as well that either don't have a Thanksgiving or they celebrate Thanksgiving on a different day. And so just make a note of that. And then on Friday, there's only a half day. Well, roughly a half day of trading. The market closes at 1 p.m. Eastern time on Friday, on Black Friday. And so be aware of that as well. Now, I had to go look that's why I was a little late getting into class. I had to go look that up because typically, as traders, you don't get too many off days. There's not too many days during the year the market is closed. And so you kind of, it's nice to have those days to just kind of get away from everything and not have to worry about positions or things like that, and you can kind of enjoy your time when you have those market holidays. So I obviously take Thanksgiving off, but I also usually take Black Friday off just because it is that half day. And now I'm not a shopper. So I'm not out shopping, but I'm usually watching football or something, any sporting event that's on TV that day. But this is kind of my favorite time of the year because I get a couple days off around Thanksgiving in the market, and then usually I'll take the week between Christmas and New Year's off. So it's kind of my time to get away from the market. And everyone needs that, especially if you're really intense in trading all the time. It can be a little bit stressful to trade, and you should have those times planned out during the year where you got to get away from it, and you don't follow the market for a few days. You don't you got clear your head a little bit because it can age you pretty quickly if you're not careful. All right, so let's get started with. Oh, and by the way, this will be the only class this week. As far as usually, I'll do the stock-specific class on Thursdays. Actually, as you're aware, obviously the market will be. It's holiday Thursday, so this will be the only class this week. So make sure you don't tune in on Thursday expecting a class. All right, so we got to try to get the whole market outlook in one day, which shouldn't be too difficult the way things are kind of setting up. Real quickly here on the direction alerts, not much has changed from the last update. We're not overbought yet. We're definitely not oversold. We're just, the momentum indicator. You still have a little bit of room to move to the right side there if the market continues to rally a little bit. Breadth is in the extreme reversal risk, so it is getting a little bit overbought. We have to pay attention to that. Breadth or sentiment is very overbought, and we're going to look at that when we look at the VIX indicator as well. We'll take a look at that, and I'll give you kind of my outlook on that, what I think could kind of play out. But it is important to note that the market is very complacent right now, and usually you see sell-offs when the market gets too complacent. Now, this is not an indicator that tells you the timing of when a sell-off could take place, but what you start to do is when these indicators start showing overbought, you start looking at, I do at least, I start looking at target areas. Is there areas of resistance that we're coming up on? Or do you see a bearish reversal candle on a particular day that could indicate that a sell-off could begin? Most importantly, we want to recognize that we're getting into a condition here where we could see a market sell-off. Now, part of the problem with that is that we're also in a kind of a historical bullish time of the year. Although I spent some time the other day, went back and looked at the last few Thanksgiving weeks or about the last 2 or 3 years, and they weren't really overly bullish weeks. In fact, there were a couple of them, well, most of them were kind of flat or kind of back and forth. So definitely to assume that this week is going to be up just because it tends to be more of a bullish time of the year, I think is a mistake. I don't think you should ever make a trading decision based on seasonality. A lot of people do, and a lot of people get burned because I've heard people say, "Oh, this is the Santa Claus rally, is going to happen, and so I'm going to jump. I want to be in the market for the Santa Claus rally," and that should never be a reason to be in the market. You want to base it off the chart. You want to base it off of the price action on the candles. And then after all that, if the seasonality lines up with your analysis, then great. That's another indicator in your favor. But just be careful. Don't ever base any decision on seasonality. In fact, a lot of times it's kind of a taboo thing to even bring up because I know there's people out there that listen to me and listen to these updates that's immediately what they seize upon. That's immediately what they focus on is, oh, it's a bullish time of the year. They ignore all the other stuff, all the other warnings I've said, and they go and jump right in. So just be really careful. And if that's the case, then they probably deserve to get burned, lose a little bit of money, and sometimes that's the only way we learn our lessons. Sometimes is when we make dumb mistakes. But we're going to pay attention to this. I'm going to show you what the VIX is looking like and what my opinion of what I think could play out in the next few days, how things might play out in the next few days. All right, going to the buy-sell ratios here again. The buys have been coming down a little bit, and that would be normal with the market pulling back or kind of consolidating a little bit in the last few days. We'll take a look at those charts here in just a second. But again, no extreme condition here. And this sentiment indicator did hit an extreme level. It was either last week or the week before. We pointed that out. It's pulled back a little bit from that. So again, there's room for the market to rally a little bit and maybe push back, but we do want to pay attention to that. There's a push back into this extreme area here that could result in a market pullback. You go look at each time we reach this extreme area, we got a market pullback shortly after. So that's why we're going to pay attention to this and really we want to really be aware of any sort of bearish signals we start to see because they could be triggering the start of that pullback. Now, this I want to point this out. I went to the index tab right here. I want to point this out real quick. This tab up here, because I told you this is showing you the buy-sell ratios of different indexes. The Dow Industrials right here, S&P 500 right here. Double digits is considered. It's telling you it's getting a little bit overbought. When they're higher double digits, the S&P 100 is very overbought at 38. There's 77 buys versus only 2 sells. That's an indication of overbought. But what's interesting here is if you move down to the broader indexes, here's the Russell 3000, which is usually what we use to look at all the stocks that we'd be probably interested in trading. Some of these stocks, you get past the 3,000 stocks out there, and you start to get into penny stocks and kind of worthless companies a lot of times by that time. But look at this, we're still in single digits. We're not extremely overbought when you look at the broad index there. So what that's telling me is that a lot of these small cap, you see a lot of the larger companies, the Dow Industrials right here, the S&P 100. These are really overbought, but you start to move out into that Russell 2000, Russell 3000. They're still single digits there. So what that's telling me is that there's not a real risk, definitely not a risk appetite out there for the market. Those professional traders are staying away from these smaller companies. They're sticking to the bigger, larger, companies out there, and we've known that. I mean, the Dow has been outperforming the NASDAQ for the last several weeks, actually the last few months, And so we're aware that that's happening, but it's kind of showing up in the buy-sell ratios here when we look at them there. So again, I just want to point that out. Not that it's a huge deal, other than we could get a little bit of a market pullback here pretty soon, and it could be that we see the larger cap stocks have a bigger pullback because they're the ones that have run up a lot further than the smaller cap stocks, and that's something to pay attention to. Do we get a market pullback and we see the Dow 30 have a bigger percentage drop than the other indexes? That's something to kind of keep an eye on down the road. All right, let's get into our charts here. And I'm sticking to, well, first of all, let's go to a 2-year chart of the SPY, and you can see the trend line, the downward trend line that I'm basing some of this analysis on. It's not going to be a real straight line I'm going to draw here because I'm free drawing, but you can see that if I draw that line out, there's still a little bit of room for us to rally up. And I think we could do that over the next few days or so. The target area I'm kind of focused on is the 407 to 410 area. 410 is about where this trend line is. 407 is right, I might have to adjust that, but it's right where the 200-day moving average is. We don't have moving averages here on TradersPro, but if you have another charting service that has moving averages, you could look at that and see where that 200-day moving average is. There's a lot of professional traders that focus a lot on the 200-day moving average, as well as like a 50-day moving average. And so anytime stocks or the market in general gets close to those averages, I tend to pay attention because they to see if they react. And so that's why I've got this little range right here where I think we could rally up to. Now, part of what I've talked about over the last week or two is that we're not the only ones that can see this area. Anyone that knows how to read a chart can see that, and a lot of people are talking about that. So that's another thing we have to be aware of, is that sometimes if everyone's focusing on the market, going to the same place, the market's not going to make it that easy for you to get it right. It may drop before it gets to that 407, 410 area, which is again right in this area right in here. So we could see the market correct before then, or maybe it pushes past it. Maybe we break out above that trend line. It looks like we're really bullish, and then it reverses right after that. So that's something just to be aware of. Sometimes we want to be prepared. We want to look at these potential areas where the market could reverse, but especially when it's pretty obvious and you can tell it's pretty obvious. Usually when I know it's obvious is when I hear other people talking about it, and that's really, to be honest with you, that's the only thing I watch CNBC for. Is a lot of times it's to see if there are obvious things that the market is showing that I'm seeing, that everyone else is seeing, and I use it to as a contrarian to then say, well, maybe I shouldn't focus so much on that area because everyone's focused on that area, So I kind of use CNBC as a barometer of whether or not I've outsmarted the market, or whether or not I've just right lockstep in line with the rest of the trading crowd, which is usually not always the best place to be, is especially at extremes. You want to be going against the crowd at extremes, and we're getting to those extremes. We're getting into an overbought market, and so we want to look for maybe ways to go against the crowd. Now we really haven't gone anywhere for the last week or so. You can see we've just been kind of sloshing back and forth. However, that behavior is important, and if you're new to trading, there's a phrase that you're going to hear me say all the time that is really going to help you make money in the long run, or at least be on the right side of the trend in the long run. It's not exact, so I don't want you to take this as being exact. It's going to work every single time. But whenever you see a stock, or in this case the market, moving sideways, you want to pay attention to the direction it was moving in before it moved sideways, because that is where it's most likely to go after it's done moving sideways. So what direction were we moving in before this sideways move? Well, we had this big, actually we only had about a 2-day run up right here. We had this big gap up. That was when the CPI report came out. The next day it went up a little bit further, and that was it. We stopped. Now, I think that's significant. I think it's significant in the context there that here we had this big report that said that inflation might be going down, and we had this huge market, one of the biggest market moves we've seen, historical market rally. Because remember, we closed all the way down here the day before. We had this big down day the day before. In fact, this is back in this week right here. We were looking at this being the start of a move down. The way it was acting, it looked like we were heading lower. That report came out, had this huge move up, and you got to ask yourself, okay, well, why haven't we gone up really any further than that? We did a little bit the next day, but we've basically been sideways since then. Well, the sideways move is the market's way of pausing and deciding what to do next. Now, we could throw in there the seasonality part of this, which is there's a lot of people taking this whole week off. I mean, if I were to take a vacation week, this is a great, as a trader, this is a great week to take off because Thursday's a holiday and Friday's a half day. So you're going to see a lot of light volume days this week. And it could be that traders are waiting until they get, next week to start to push the market in a direction. But from a probability standpoint, and again, it's important to point out this isn't exact. When you see a market moving sideways like this, you want to pay attention to the direction it's moving before it moves sideways, which was up. We should have another move up. Although, again, don't forget that, which is probably long. All right, see here. That downtrend line I just drew you on that longer term chart, we think we're going to push up into this area up in here. And then maybe have a bigger drop. Or maybe not. Maybe we just keep going higher. Again, I'm not locked into any market direction where I'm gonna ignore what it is actually doing. If it keeps going higher, then hey, maybe we're in for a much bigger rally. But again, I get back to we haven't seen that panic sell off yet. I've never experienced a major market bottom without one. And so I still am kind of expecting that at some point. And we really haven't, we're starting to see some of the inflation numbers come down, but what's really freaking some people out is we're also seeing a lot of recession signals. And some people are pointing to like spring to summer of next year, we could see a recession, and that's actually what the Fed wants. They're not going to come out and say it, but that's part of how you deal with inflation is you go through a recessionary period where people stop spending so much and they're afraid to spend, and the Fed wants to get to that point, and we're really not there yet. Where people are afraid to spend. And so that's one of the reasons why I think that we haven't seen the worst of this yet, because the Fed isn't going to stop until they start to see that. All right, so near term, it's looking like we could move higher. Today's a little bit of an up day. If I put the volume bars, I usually keep the volume bars off because it gets too much on the chart there, but you can see very light trading volume. We've had light trading volume yesterday. We're going to have very light trading volume tomorrow and Friday. So if you're looking for volume confirmation, you could say, well, Jerry, we're up today, but it's very light volume. Yeah, you're going to have that because of just the time of the year or the particular time of time of the year, their holiday week. But that's why you have to, if you normally like to see a lot of volume confirmation, you have to adjust your expectations there. You're not going to get it on these weeks. And so you can either not trade at all or just, not put as big an emphasis on the trading volume. All right, so S&P looking like it could go up. Dow, now the Dow, one thing I'm paying attention to the Dow is that this previous high right here, which is right about 343, as you can see. Again, still looks like it could push a little bit higher, but on both these charts, we're not looking at too much more of a move higher where we could start to see a reversal. And again, it may not get to that exact spot or area. It could reverse a little bit sooner than that, so just be aware. But the Dow is near a previous high that could act as resistance. Although the Dow is the only index that really looks bullish. This looks like a clear uptrend. It doesn't look like a correction, but that's what's been conflicting us the last few months. Is you flip that over to the NASDAQ, and the NASDAQ 100 absolutely looks like a correction. Excuse me. This looks like a bearish ABC pattern to me, correcting this move down. And when this is over, I'm expecting, it could have another move down. Now, in the near term, could this be still part of usually your wave C in a bearish ABC pattern will have 5 waves in it. This gets into Elliott wave, but that could be wave 1, wave 2, 3, wave 4, and have one more push for wave 5, and then get that bigger drop. Again, all these are kind of lining up to show the same thing, that very near term, we expect that the market could move higher, but keep in mind, it could still just move sideways. Like I said, I went back and looked at a lot of these Thanksgiving weeks, and there were a lot of them that were really kind of sideways. So make sure you're aware that that's a possibility as well. It's also possible that this could be just wave A, wave B, wave C, get a little bit of a wave C, and then it pushes up into that 407 to 410 area. The only reason why I'm again being a little bit more bullish is because we're up today, and again, typically this time of year tends to be a little more bullish, but it could be more. We could still see some sideways movement for another week or so. That's definitely possible. The Russell 2000, same thing. It still looks kind of corrective. Notice again the choppy back and forth. It's really kind of sluggish on this rally back up. The Dow, like I said, is the only one that really looks like it's in a strong uptrend. And the problem with that is typically the Dow isn't leading the way. It's usually the small caps or the NASDAQ that's leading the way. All right, bonds. We were talking about the possibility of bonds forming a bearish ABC pattern right here, and possibly having another move down or having a move down. The last few trading days, we've seen it just move sideways. Same thing. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. And so this is looking more like it could be heading higher. And, typically your wave A and your wave C will be about the same length, maybe a little bit shorter, a little bit longer, but wave C is almost twice as long as wave A. Now you have to start looking at the possibility that we have a trend reversal here in bonds. And that's something we're going to keep an eye out for. I mentioned this in the last update. Now that we're moving higher today, if we push up too much higher here, you have to really start to look at the possibility that you're in a trend reversal, and we could see bonds start to trend upward, which is probably, bonds have been beat up for a long period of time. They come way, way down. That it wouldn't be shocking to see them start to rally up. Although, I'll say that, and then we get a massive move down probably as it continues the downtrend. The trend is still down. I want to point that out. The trend is still down. We're just wondering if this is just a correction within the downtrend. We're going to head lower, or like I said, at some point we're going to start to trend up. Now, what would be some behavior that we would look at as far as this making it more likely this is an uptrend now? Well, again, if we have an impulsive move up and move up for a few more days, and then we pull back, when we pull back, it's a little bit more choppy, more sideways like this. So you notice how these last couple pullbacks have just been sideways pullbacks. That's acting like an uptrend. That's acting like it wants to keep going higher. If it keeps doing that, you got to assume that it's acting like an uptrend, so you can assume that it's now in an uptrend at that point. So we'll keep watching that. I'll comment on it as I see that chart play out. Gold's pulled back a little bit. Remember, it was right in the far right side of this extreme reversal risk when it was at the peak up here. So it's not surprising that it's pulled back a little bit. But we're seeing the dollar come down today. At least last time I checked, the dollar was coming down. So that is going to be more bullish for commodities in general. We've seen oil rally the last couple of days. I wouldn't be surprised if the dollar keeps coming down, if we see gold go on another run. It's hard to tell right now if this is just a pullback within, we did break to a higher high right here. Are we going to start stair-stepping up? We don't know yet. And the pullback didn't give us much of a clue. What I would have liked to have seen on the pullback is a little bit more of a choppy, corrective type look to it. And this was an impulsive look to it. Remember, when trends reverse, you tend to have you tend to alternate between, when you're in an uptrend, alternate between impulsive and corrective moves. And then when you change trend direction, usually, not always, but you tend to have an impulsive up, impulsive down, and then your correction is more choppy when it tries to rally. So if we see gold have more of a choppy move as it's trying to rally right through here or move sideways, then we might assume that maybe we're reversing right back down into a downtrend. Maybe the next move is going to be an impulsive move down. So now there can be times in an uptrend where you get your correction is just a sharp move and then it takes off again. It's usually pretty rare though, and that's why we don't have enough information here to determine if this is just a pullback within the uptrend or if it's gone back into a trend reversal back down again, just reversing back into a downtrend. So we'll keep an eye on that next few updates and see how that starts to look. Oil, like I said, had a big reversal yesterday. There was the big OPEC meeting was it December 7th, 4th or the 7th? I can't remember. I don't usually, I'm more of a chart person, so I don't get too caught up in when reports come out or when meetings happen, just because usually what will happen is a day or two before everybody will be talking about it, so I'll be made aware of it. I don't care what happens, what the news is leading up to the event, because I'm just going to go off of what the chart is telling me anyway. But I think it's like December 4th or December 7th, one of those days, the OPEC has a meeting and they're deciding whether to increase production or decrease production. Remember, they're more likely to decrease production because it means the prices will go up and they'll make more money, and they won't have, make more money and not, lose as much oil. They're making more money on the oil they're selling. Obviously, there's some world pressure for them to increase output, to especially going into the winter. That's also the date when the significant about that date is that's when the Russian boycott is supposed to officially be underway. People aren't supposed to be buying oil from Russia. Obviously, that could end up affecting supply and demand. Now, again, I'm not going to spend the update talking about the fundamentals of oil, just the fact that it's been moving more sideways. I've been more bullish on oil, but only if this low holds. We started to get a higher high right through here, but we kind of dipped to a lower low right through here. This is a major low in my mind. If we back out, we can kind of see. Let's back out to a 2-year chart here real quick. So the overall expectation, we had this long uptrend, was that this was an ABC correction. That's at least been my argument, that oil has had this correction. And then we were, although sluggishly going up, we were still going higher high right there. This is a higher low. We've now had a lower low, but we've got this bullish reversal candle here. As long as this low holds, I think there's still an opportunity for the market to go higher. And actually, what I think could be playing out is that this is just going to be a larger correction, meaning that because just the sideways nature of all this is corrective. Whenever it's choppy and sideways, it's corrective. It's not showing from this low. It's not showing an impulsive direct. It's not showing me that it's in a strong uptrend. So I'm wondering if this is just wave A right here, and that this is kind of an A, B, C, maybe rally up into this area up in here to complete wave B, and then we get a bigger pullback down in here for wave C. That would line up a little bit better with how it's behaving. It could also line up to where if demand for oil picks up after this deadline, it could rally up a little bit further, and then who knows, maybe the supply. Part of what again, this is why I don't get into the fundamentals very often, because it's just too much work to kind of keep up on that. But I've talked a little bit about the fact that oil there's clearly going to be world demand for oil, but also the European countries have been stockpiling oil for the last since the war in Ukraine started. So they could be fine, and there could actually be a glut of oil, too much supply that could weaken oil prices. I don't know. I don't care. Whatever the chart is showing is going to be what I want to trade anyway. But that's something to keep an eye on in the near term. Is this reversal that happened yesterday? Does it continue? Now we're off the highs of the day today a little bit, so it's not showing a real strong follow through to that. If this bullish reversal candle fails, if we dip below that, we're probably going to dip below this low too. Now, I've got a lot of oil stocks that have actually done very well today in the portfolio, but I talked about this last class that I might be leaning towards lightening up on those if oil continues to kind of trend down or continues to look weaker. I might want to kind of trim that down a little bit. So we'll see. I don't like the way it's faded a little bit so far today, and that might change between now and the market close. Near term, I would have expected a little bit stronger follow through yesterday's move. But again, we're in a holiday week. It could be that we're just pausing. We could see a pause just for the rest of the week just because of that, and so keep that in mind. The dollar is going to be significant. We've seen the market drop when the dollar's rallied. So we've rallied right through here. Actually, a little bit choppy right through there. Market has been a little bit choppy lately, but there's been that correlation. Now, again, it's not always going to be that way. Don't write this into your trading plan for your whole trading career, that anytime the dollar goes down, the market goes up, and the dollar goes up, the market goes down. That's not going to be the case. That is not the correlation that always exists, but it is right now. And so pay attention to the dollar. One of the first things I do when I start doing my chart analysis, I go straight to look at what the dollar is doing. And then I want to see if the market is still following that. And what I think is happening here on the dollar is I think this was a correction. Had this impulsive move down. This is a correction. And I think it's starting to move lower here. So that would cause me to be a little more bullish on oil, a little more bullish on gold. a little bit more bullish on other commodities like wheat, corn, and companies that are related to that, or a fertilizer stock, the CF we have in the portfolio rallied pretty strong today. And probably will continue if the dollar continues to move down. So we're positioned pretty well. If the, oil, I mean, look at what we have in the portfolio. We have oil stocks. I've got coal. I've got the ADM, which is a kind of a farming type, commodity type company. We've got fertilizer stock and CF. Now, if the dollar starts taking off, we're not going to be positioned right for it. So we're actually kind of rooting for the dollar to continue to drop. Although again, what that does is it's going to be it's going to be more bullish for the market right now because the market's reacting to that. So that would be a little bit more bullish. Now, keep in mind though, where the market is getting into that resistance area though. So maybe what we see is the dollar come down. Maybe it just comes down, forms a double bottom. Maybe we see it rally up, and maybe that could be a reason why the market sells off. Maybe we get a little bit bigger rally at some point in the dollar, or who knows? Maybe the market just stops reacting to the dollar movement and focuses on something else. VIX has come down quite a bit. Now, this is where I'm going to flip over to my other charting service here, because this is the actual VIX chart. I've talked about this 20 area right here. When the VIX gets down around 20, that tends to be where sell-offs start taking place. We saw a sell-off back here. We can go back further. I can zoom this in a little bit. You can see, and it's not exact. So again, this is why here we dipped below 20 before its market sold off. Here it was right at 20. Here it dipped below 20 before it sold off. So could it come down even further? Yes, it could. But what I'm looking at is that this doesn't need to come down very much further to get to 20. And remember, we have that resistance area on the S&P. It almost lines up to where if the S&P gets up to that, SPY gets up to 407 to 410 in that area there, the VIX will probably be down around 20. Now, maybe that's lining up too perfectly. I'm aware of that. But we're definitely paying attention to that, and I want to look for any sort of bearish reversal if we do rally up to that area that could indicate that I might need to hedge a little bit in the portfolio in case the market starts selling off a little bit. So that's something to pay attention to. Chip stocks, they had a pretty good run right through here, where they started here. They were really lagging, and I really thought we were going to drop right on that candle right there. This is that CPI report came out, and they actually moved up pretty good off after the CPI report, although the last few days we've been moving sideways like the rest of the market. Up a little bit today. Again, I still think these could rally a little bit, although they've been lagging still for the most part. And chip stocks, the reason why we're looking at this is this tends to be a leading indicator for the NASDAQ 100. Now, the NASDAQ 100 has been lagging the chip move. The NASDAQ 100 didn't move up as strongly as the chips did right in through here. But again, could this mean that we're going to see a bigger rally? That's what I'll be watching. If we do start to see the chip stocks really start outperforming, then maybe the NASDAQ 100 starts catching up. We compare the Dow Transportation Index to the Dow Industrials. The transportation stocks are underperforming, although they had a pretty good run up right through here. But remember, the Dow Industrials are up here. They're about to break out above that high or get up to that previous high. That what was that? September? Was that September or August? The August highs right up here. So the transports are lagging. They're supposed to be leading. Still watching that. Bitcoin has kind of rallied the last couple of days, but this is, it broke that support area on this drop. It obviously the news with FTX and everything out there that is really a problem there. Although I did talk about this last week where I said, if you want an example of what I keep talking about, where a panic sell-off has happened, that's what's happening in cryptocurrencies. I think that it's acting, cryptocurrencies are acting like they're near a bottom. Now, I want to be really clear and make sure you understand what I'm saying. I'm not saying go out and buy cryptocurrencies because they bottomed out. They're showing signs of a bottoming process. What you would start to look for is, do you start to see signs of an uptrend? We don't see that yet, but do you see Bitcoin get back above this huge sideways area it had? Does it start stair stepping up and get through this area here? Yeah, then you could make the argument that it's bottomed and it's now in the early stages of an uptrend. But remember, when the markets have when something is bottomed, you're not going to feel like you want to buy it. And Bitcoin and other cryptocurrencies out there are like that. You're wondering if the crypto you're holding is going to go bankrupt. You know, the FTX was supposed to be this stable. I mean, there were hedge funds that were and pension funds that were investing in that thing, and it blew up. So, but that happens at bottoms as well. Companies in you remember the internet bubble, a lot of internet companies went out of business. Some of them, the ones that survived did pretty well after that, but a lot of them went belly up. Well, that's what you see at bottoms. In the financial crisis, we saw banks go under and financial institutions go under. And so that typically is what happens when those things, when you start to bottom. But if you remember about the financial collapse, remember we saw the companies go under. We saw a massive sell-off in the fall. It was September and October of 2008. And when did we bottom officially on the chart? It wasn't until March of 2009. So that's what I'm saying. It's showing the signs of a bottom, but it may not be bottomed yet. It could still maybe have a little more damage to the downside. So I just want to be clear on that, because I know there's some people that are only going to hear bottom and they're going to just go jump in, and they're going to look for the cheapest cryptocurrency out there, and they're going to go grab Dogecoin or something or whatever, one of these ones that's probably going to go under, because it's cheap. Just be careful. But I just want to point that out, because that's what we're waiting for in the market, to see the market sell off to where we're wondering how much further it's going to drop. I don't feel safe to buy anything right now. When you get to that feeling, that's when you know you're close to a bottom, and or you could be in the bottoming process. All right. Oh, high yield corporate bonds. You've been watching this again and moving sideways right here. Previous move was up. We should see a move higher out of this when it's done moving sideways. I mean, it could have a move down and still be considered in the sideways range. But when it's done moving sideways, it should have at least another move up out of that. And the market's been kind of following this chart a little bit, but this ties into again the argument that the market could be a little bit more bullish still in the near term. So bottom line, we think there's a little more, still some upside here in the market, but when we get close to that 407 to 410 area, we're going to be a little more cautious. We're going to see if the VIX is down around 20, see if we get any major bearish reversal signals, and then what we'll do is we'll go in and probably hedge a little bit on the portfolio. That the ones I hedge with the most are the SOXS. This is the inverse of the chip stocks. So this is going to go up when the chip sector goes down. So basically when the market starts selling off, this will go up in value. But it allows us to be long be able to make money when the market goes down without being short the market. I don't like to be short. So this is going to go the opposite direction. The market starts selling off, this is going to go up. I use this to make some money as the market goes down, make some money in the portfolio, hedge the long positions we're in, but I don't see a reason to do that yet. But this is one of those that I'll use to hedge. The other one is the SARK. This is the opposite of the ARKK, which is the Kathy Woods fund. She has a lot of very risky small cap. Well, not all small cap. Tesla is one of her biggest holdings in that. But this is another one that tends to, well, it has been going up. When the market goes down, this tends to go up. So this has been going up. Let's look at the ARKK. Boy, that's been dropping quite a bit there. Yeah, well, I wish I would have paid attention to that. I would have jumped in that just to. But usually, I'm only going to do this to hedge. So when I'm not expecting the market to go down, yeah, that's been going up the last few days there. But this is another one I'd probably look to jump into if the market starts selling off. All right, let's look at the portfolio here. We're trying to crack that 140,000. We're right up to 139. Again, we backed off to about 137. But a lot of it is due to that dropping dollar today and our energy stocks taking off here. Here's the natural gas trade. Now my stop is down below here, so I'm giving this a lot of kind of flexibility here, but that's a pretty nice up day today. And again, because we pulled back, we're not near the extreme reversal risk there. Now, MPC is getting close. Let's see what that one looks like. Now we're just getting into the extreme reversal risk. I'm gonna hang on to that one because it could still run for a few more days. But I might take profits on it if it gets to the far right side of this. Or actually, you know what I'm going to do? I'm just going to move. My stop was all the way down here. I want to give it plenty of room. I'm going to move it right below here. I might as well lock in some of the gains that we've had on this one. So what is the low of that day yesterday? Remember, yesterday was that bullish reversal day. We break below that low, I probably want to be out of oil stocks in general. So this was at about 160. The low that yesterday was $116.59. I'm going to put 116. Let's just do $116. Just a round number for a stop there. So let's go to the portfolio and bump that stop up. Here's MPC. See, I bought it at 99.87. If I put that stop in at 116, it means that we should be able to get out of that at a profit. I had my stop at 101, so we're going to move it up. Oh, wait, no, I don't want to sell it. Hold on here. I want to move my stop up right here to 116. Tech, Tech faded a little bit. It was having a little bit stronger day there. My stop again is down below here. Let's move the stop up a little bit. Let's move it below this low. 29.75. I'm gonna say let's just put 29.70 as the stop. 29.70. So I moved it up from 28 to 29.70. And now I entered in at 33, so that would, if we got stopped out, that'd still be at a loss. But and then this is our coal trade, CEIX, got very close to, my stop's down below here, got very close to stopping out, but it's moved up pretty nicely. I'm not going to move my stop because it's already down close to it. Hopefully this can start making us some money here. And then CF, this is the fertilizer stock. A nice move the last couple of days here. We've been stuck in this range, so I'm really hopeful we break out of this range. And if we can, it'll be more likely we'll get up into this area right here. My stop's down below here. I guess I can move it up. Let's move it up below this day just to move it up. Because I again, if it's all these, if they start heading south, if it gets below this low again, it's probably heading down. After this long sideways move, it's probably heading much lower at that point. So $95.43. Let's just put $95 for our stop. Moving to that $5 here. And silver, again, had that big dip right there. It's starting to move up a little bit, I think because the dollar moving down. See if that one gets back to trending up again. And then ADM, this is another agricultural. This is under agricultural operations industry, consumer staple stock. And it's looking like it could be getting close to breaking out here. So we're going to just hang on to that one. This one doesn't look. I'm going to keep my stop on this one. I think my stop is down here a little bit further. It's not all the way down here. I'm pretty sure. I think I put it right in this range, right in here, just kind of below this. This is the breakout area. It broke out and I came back and retested it. I think I just put it down here just a little bit lower in case it comes back down into that range again. At 90, yeah, I have it $91 my stop. All right, and I don't really want to add anything to this. And you can see I'm mostly in cash. But again, this gets back to the analysis. I'm expecting that maybe the market just moves up a little bit further. If it starts taking off again and we break out of that downtrend line on the SPY, I'll probably start adding back in, adding more into the portfolio there. But I'll stick with what I have here, and then if we start to see it sell off, I'll jump into those inverse ETFs. By the way, some examples of inverse ETFs. I've got a few of them here. These are just the main market ones. SH, SDS is a leveraged inverse ETF. The problem with like the SH, you say, why not just short the S&P 500? Well, the problem with that one, if you haven't heard me explain this before, it doesn't hedge you very well. If you get a massive sell-off, you buy it at $15, you get a massive sell-off. This thing goes way up here. You only made about $1. How can I make any money on that? Whereas if you look at like the SOXS, if I got that same move up, or the market dropped by that amount, this moved up that same amount, it could go from 35 to 50. I mean, there's a $20 move there. I could make money on that. Okay, so that's why I don't. It's not worth my time to use the SH or some of those other ones. They're not going to help, But that's a list of them there if you want to kind of have something to kind of keep an eye on there. All right, real quickly here, I'm just going to go to the muscle stocks. This is kind of this will be the stock specific part of the class this week. Although I do usually in the market update go over some stocks. These are stocks that have gone to a new buy. What I'm looking for is I want to make sure they have a high strength rank. So all I'm really going to look at are these stocks that are in the 90 strength rank or above. Sometimes I'll dip below that. You've seen me dip, 87, 88, but I try to keep it in that 90 range. And then I'm trying to look for patterns that look bullish. So I not only have a stock that's the software is saying is outperforming and trending up, that has gone to a buy signal, but I also want to make sure the chart patterns and the overall trends are showing that as well. That's where you really get the most out of the software, is to combine the two. And it does take a little bit of knowledge to learn how to read trends and your trend analysis, but it can really increase your probability of picking the right stocks when you can kind of combine the two. If you don't want to, all you want to do is just go off the signals, then that the software is there to make it real simple. But like I'm saying, just like anything, if you're willing to take a little bit more time and educate yourself, you're always going to have better results in anything that you're using or doing. Hopefully that's not, surprising to say, for anyone for me to say that. It's just one of those life laws, so to speak, that you're willing to increase knowledge in something, you're going to do better in it than someone that isn't. What the software does, if you're just going off the software, you don't want to learn how to read charts, you just want to get better results. Your chances of getting better results are always going to be better when you're investing in stocks that are performing, that are showing the signals of that they're performing. I do like this one, AXSM. Let's switch this over to signals here so you can see the new buy signal. But one of my favorite patterns is when you've had a deep pullback and then you look like you're going up the right side of the bull. You have this higher low right here, higher high right here. It looks like you're coming up the right side of the bull. We should get back up to this previous high the way the stock is acting. Not guaranteed, nothing's guaranteed, but it's acting like it's heading that direction. It wants to get back up to that previous high. If it breaks out above a bull, now a lot of times we call it a cup with handle, because this will be the cup, and then it'll kind of move sideways near this high that creates the handle. If it breaks out above this area right here, there's a rule of thumb where you can take the top of the bull to the bottom of the bull and project that upward, and that gives you a kind of a minimum target area. Not that it goes right straight there, not that it has to go there, but it does it enough times to where we can call it a rule of thumb. And so there's multiple ways to trade a pattern like this. You can either trade it early up to here when it gets back up to that bull. You could wait till it breaks out of the bull. You could get in here and then add to it if it breaks out of the bull. There's lots of different ways you can manage a pattern like that. This one's too erratic. I don't like that one. It's all over the place. I'm going to switch over to LW. I like this one right here. There's a higher low. It's getting ready to break out. Now you could wait for the breakout as confirmation. I'd probably recommend doing something like that. Wait for the breakout if you're looking at something like this. But it's acting like an uptrend. This is in the consumer staples sector, this is what you want to be in consumer staples during recessions and the economy slowing down, because these are products that people will buy no matter what the economic conditions are. They still need toothpaste, they still need hair products and food and all that kind of stuff. Those are areas you'd want to be in. I like this RJF. This is Raymond James Financial, although it's a little extended. This wasn't a very deep pullback right here. So one thing you have to worry about is maybe that was just wave A, this is wave B, and then it comes down a little bit deeper. Here was the breakout. A lot of times you'll retest the breakout. It doesn't have to, though. And this is another one that if it broke out to a higher high right here, you can just buy that breakout there. Financials, those stocks do pretty well in this type of environment, tend to do pretty well. And then the last one is T-Mobile. Nice little corrective pattern right here. Looks like an ABC, big bullish candle right here. And it went back to a buy signal. Here is the breakout area. Now it came back to the broke out, came back to the breakout area, actually dipped a little bit below it. This is what I'm talking about. Sometimes everyone knows how to read breakout areas if you know how to read a chart. And so sometimes it'll fool you a little bit. It'll come back to the breakout area and then dip a little bit below it. So you think, uh-oh, it's not holding it, and then come right back above it again. when it comes back above again, that's a pretty good sign. It means that typically that means the buyers are pretty strong if they can come back and push that back to a new high again. So I like this pattern. And although this is in the computer and technology, this is kind of a consumer staples. Verizon is in the category. AT&T. People are going to pay their cell phone bill. They're not going to cut off their cell phone during bad economic. In fact, I've seen homeless people on the street begging for money that have their phones. so they that is what and they're foregoing food. They're begging for food, but they're going to keep their phone. So I think this squarely fits into the consumer staples category here. These wireless companies, I think they're ones that you can own during these types of environments, because people they're gonna hold on to their phones no matter what. All right. That's all I have. Any questions for me before I wrap things up? If not, if I don't get to them, make sure you send them to me. I will be checking emails periodically, maybe even in between football games on Friday. But so don't be afraid to send me a question if you think of something during the holiday week. But I do want to wish everyone a happy Thanksgiving and a happy holiday time of the year here. There's a question here. Hold on. What is the significant difference between the Russell 1000, 2000, 3000, other than the number of stocks? Well, for the Russell 1000, the Russell 1000 has all the large cap stocks. It's the top 1,000 stocks. So it has Apple and Google and Amazon. It has all those stocks in it. But then it extends down to obviously smaller companies. When you get into the Russell 2000 is the main one people will focus on for small caps, because obviously the Russell 2000 includes all the large companies as well, but then it extends down to those smaller companies. And what it shows you, the reason why we look at that is because when professional traders are feeling confident in the economy and in the trading conditions, they're willing to take the risk of buying those smaller companies, because those smaller companies are more likely to go from they're usually more likely to go from $10 to $50 or something like that, which is, again, that's a huge percentage move. Whereas, you're expecting Home Depot to go from $300, maybe it could go to $400, but that's not as big a percentage move as going from 10 to 50. So it's a reflection of risk on. Are those professional traders diving into those riskier companies? If so, it means they think that the conditions are more bullish, or there's more optimism, more reasons to believe that the market's going to continue to go higher. Because otherwise, they're not going to do it. They're going to do the opposite of that, which is what they're doing right now. They're getting out of everything risky or anything that's not making money, and they're getting into companies that are stable, that are still making money in this environment, that are able to fight off the inflation problems. And so that's why I'll look at the small caps. Now, is there a big difference between the Russell 2000 and Russell 3000? Well, there's not 1,000 stocks. The Russell 3000 is usually going to incorporate every stock that we're going to want to get into. And even then, you're getting into stocks that are borderline penny stocks. So mostly, and I don't really even look at the Russell 1000 very often, because at that point you're looking at the S&P 500, which is the main index. You're dealing with 500 of the largest companies. And then the Dow is only 30 stocks, so it's not a great representation of the conditions as a whole. Hopefully that answers your question there. But usually when I'm looking at the Russell 2000, I'm looking for that risk on. Is there a risk on appetite? And we're not seeing that right now. It's lagging. It should be leading. When it's leading the way, you know that you're in a pretty strong market condition. I'll do one more question here, and then I got to wrap things up on here. There's a question on GPC. It's consolidating and it's trending up. So I mean, you're long it. There's nothing there saying that to not still be long it. It's not overbought yet. It's still trending up. So yeah, it's the best I can tell you on that is that it's now if you're looking to short it, you would be shorting it. But yeah, there's no reason. It's not. It's acting like it's still moving up. All right. Thanks, everyone. Have a great Thanksgiving holiday, and we'll be back to the normal schedule next week on Tuesdays and Thursdays. And until then, like I said, have a great weekend. Bye now.